So your reaction to Singapore's MES decision?
I think in the back of their minds is inflation, and that is probably why they want to keep the Singapore dollar as high as possible. What they don't want to do is to ease and then suddenly find that the Singapore dollar falls against other currencies, which therefore also means that any imports that come into Singapore will be more expensive. So they are very mindful of the fact that inflation is going to be a problem. And that really is the result of these Trump tariffs, because what it could do is to break a lot of the supply chains. And if supply chains are broken, as we saw during the time of the pandemic, prices start to rise. And I think this is one of the big problems that Singapore will have to face. And so, yeah, inflation may moderate, but what we're actually comparing is inflation today with a year ago. And we know that a year ago prices were very high. And this is the nonsense about inflation all the time. They always compare inflation today with 1 year ago. You ask me whether or not prices today are more expensive than they were 5 years ago, and I would say, yeah. I mean, you go out and try and find a cup of coffee these days for less than $1 Singapore dollar. It doesn't exist anymore, whereas previously it did. You could find coffee at 80 cents, $1, and it doesn't exist anymore. What are we looking at now? Close on to $2. So we're really sort of comparing $2 for a cup of coffee now with $1 5 years ago. You might say, oh, compared to last year, there is no inflation. Sure, but prices have already gone up so much. And I think this is the same thing that people will be having this conversation with America. They're going to say that, hey, you know, this time next year, there's going to be no inflation in the system. Yeah, because they had this one-off shock where prices went up so much, and then you're comparing prices now with that one-off shock, and you're saying, oh, there's no inflation in the system. And this is something that I think every investor needs to be aware of, that inflation is always there. It's everywhere. And unless you are aware of it, you're just going to be lulled into this false sense that, oh, inflation is below 1%. There's nothing to worry about. I'm sorry, it's not below 1%. Mm-hmm. When you compare it to what it was 5 years ago, it is not 1%.
Right. And over the last few years, David, when you talk to retailers in Singapore, whether it be restaurateurs or shops, actually, a lot of them will say that traffic, consumer demand has indeed waned. Yeah. And also because of the fact that people are saying, hey, you know what, the price of things right now are a lot more expensive than 2 years ago. Forget the rate of change over the last 12 months. But I am curious, what does this do to the earnings outlook? Because if people are spending less, could that actually feed into companies via second order effects, and thus also impact the earnings potential of these companies, and thus also perhaps cast perhaps a second order blight, at least, or shadow on the market outlook right now?
It really depends on whether those companies have the ability to pass on the price increases. I think what we've actually seen here in Singapore, I mean, anecdotally, there are many food and beverage outlets that are finding that rent has gone up, and the cost of food has gone up, and labor has gone up. And they're saying that it's almost impossible for them to actually pass on those three price increases onto consumers. If they do so, nobody's going to come into their shops and eat anymore. So what they're saying is, let's call it a day. Once their leases run out, they'll say, that's it, time out. I'm stopping now, and I'm going to try and find some other way in order to make a living. I'm not going to be able to do that through what I was doing previously. In other words, selling food or selling clothes. And many of these companies are giving up. And other companies will come in. Those with pricing power will come in, and they'll say, yes, we can compete because we have that ability to pass on the price increases to the end user. So in answer to your question, I think from a stock picker's point of view, what you need to do is to pick those companies that we talked about earlier on, that have pricing power, that have the ability to pass on those price increases to people. And those companies are the ones that make things that people either can easily afford or can't easily do without. So a good example would be a company like Coca-Cola. It can pass on that price increase if it wants to, simply because adding on 10 cents onto something that costs $1 is a 10% increase in price. But it's still only $1.10. And it's a bit like that cup of coffee we were talking about. You know, anything below $2 is still easily affordable. It's not as though you need to take out a mortgage to go and buy a cup of coffee. So therefore, you would say, yes, I can afford that. Yes, it's gone up in price. It's gone up from, $1.60 to $1.90. That's a massive increase percentage-wise, but it's still only $1.90.
So again, my question is, does all of this change the narrative as to how you approach the Singapore market, which is predominantly banks and property, real estate investment trusts? Boring, some might say, but steady Eddie, dividend yielders. How are you approaching the Singapore market?
Well, certainly the banks are attractive. I mean, can you do without a bank, Sri? I mean, if the bank were to increase the interest rate on any loans, I know you don't have any loans, Sri, because you're so rich anyway that you don't have any outstanding loans. You probably just have a savings account.
Warren Buffett, we're like that.
Wealth management, yes.
No, the thing is, I mean, if a bank were to increase the interest rates and say this is what it's going to cost you now to service your mortgage or your car loan, you're going to have to pay it. You don't have a choice. So it comes down to what I said, things that you can either easily do without, or things you can easily afford, or things you can't easily do without. You can't do without a bank loan, so therefore you're going to have to pay it. There's no choice. And as far as some retailers are concerned, they're in the retail trade. They need the space. And if they have that pricing power, they'll be able to pass on any increase in rent to their consumers. And it's the same with, say, the medical field. I mean, you look at a company like Parkway Life. I mean, they own the properties that Mount Elizabeth and Gleneagle sits on. So they increase the rent for all of their doctors, all those surgeries. The doctor then passes on that price increase to you in the form of, consultation. If he adds on another $10 or $20 onto your fee, are you going to say, no, I'm not going to have my knee done today because, it's too expensive? You're going to pay it, Sri.